It's 2 a.m. in New York. The trading floors are dark. No headlines, no breaking news. But somewhere in the financial system, a number quietly jumps. And a few of the largest banks in the world stop sleeping well. Most people will never hear about it. Markets might even open green the next morning. Yet this small, boring corner of finance decides whether banks feel safe or start preparing for emergencies. This is the market that only shows up when it's already too late. And right now, it matters more than most people realize. Because modern banking doesn't really run on deposits. It runs on trust that lasts exactly one night. Let's set the scene. Every major bank ends its day with a problem. Some have extra cash they don't need. Others are short and need it immediately. Not tomorrow, not next week, tonight. So they meet in a quiet place. A place with no commercials, no retail investors, no hype. It's called the overnight lending market, and more specifically, the repo market. Repo sounds technical, but the idea is simple. One bank says, "I need cash tonight." Another says, "I have cash, but I want it to be safe." So the first bank hands over something valuable, usually government bonds. The second bank lends the cash. Tomorrow morning, they swap back. Cash plus a tiny bit of interest. That's it. A one-night promise. This happens every single day. Trillions of dollars. Over and over. So often that no one notices until it breaks. And when it breaks, nothing else works. Here's the uncomfortable truth. Most big banks cannot function without this market. They don't keep giant piles of unused cash just in case. That would be inefficient, expensive, bad for profits. Instead, they assume the overnight market will always be there, like electricity, like oxygen. That assumption has failed before. In September 2019, something strange happened. Overnight lending rates suddenly spiked. Not a little, they exploded. Banks that normally borrowed at around 2% were being asked to pay 8%, then 9%. Some couldn't borrow at all. There was no war, no recession, no pandemic, just silence and fear. The central bank had to step in within hours, hundreds of billions of dollars, quietly, no press conference, no panic allowed. Most people never heard about it, but insiders remember it as a warning shot. Because the repo market doesn't fail loudly, it hesitates, then freezes. And a frozen overnight market means banks don't trust each other by morning. Why would that happen? Because the system is built on collateral. And collateral isn't just about value, it's about confidence. Government bonds are supposed to be the safest thing on earth, but even safe things can become inconvenient. Sometimes there aren't enough of them in the right places. Sometimes regulations lock them up. Sometimes everyone wants the same bond at the same time. And when collateral becomes scarce, trust evaporates fast. Here's where the math gets awkward. The global financial system has grown faster than its safety rails. Trillions in assets, leverage stacked on leverage, all balanced on the assumption that short-term funding is always available. But overnight lending isn't guaranteed, it's optional. Every night, lenders choose whether to show up, and that choice is driven by fear, not formulas. When lenders hesitate, rates rise. When rates rise too fast, borrowing stops. When borrowing stops,
banks start selling assets fast. That's when problems spread. The irony is brutal. This market exists to make the system safer. Short-term loans, high-quality collateral, constant resets. But those same features make it fragile, because everything resets every night. No long-term commitment, no loyalty, just math and mood. Compare that to the hype. People argue about stock bubbles, crypto crashes, housing prices. Meanwhile, the plumbing that keeps banks alive runs silently in the background. Ignored, underfunded, assumed, until it demands attention. Central banks understand this. That's why they now act as lenders of last resort every single day. Not just in crises. They inject cash, they accept collateral, they smooth the system. Not because something is broken, but because something might break. That's a subtle but important difference. We've quietly moved from emergency support to permanent backstop, and no one voted on it. The system works until it doesn't, and when it doesn't, it moves faster than politicians can react. Banks know this. That's why they watch overnight rates like heart monitors. A tiny spike can mean nothing or everything. It's why traders check one boring chart before they check the stock market. It's why central bankers lose sleep over markets most people can't pronounce. Because if banks stop trusting each other overnight, the damage doesn't stay overnight. It leaks into mortgages, business loans, payrolls, pensions. Not through drama, through delay. The scariest part isn't collapse, it's hesitation. A system that pauses, even briefly, reveals how dependent it is on constant motion. So tonight, while markets close and headlines fade, the real question isn't what stocks will do tomorrow. It's whether banks will quietly lend to each other again. And if one night they don't, what happens the morning after trust takes a day off?